Good morning, students. Welcome you all today on the lecture on Ind AS 16 Property, Plant and Equipment. Students, this Ind AS 16 is a very critical from real life perspective as well as examination perspective. And you will expect at least 5 to 8 marks question from Ind AS 16. It's a very important standard. It's a fixed asset based standard. The name is Property, Plant and Equipment. Friends, just to give you a comfort, if you guys have already read AS10, which I'm sure that in CA Inter or IPCC, AS10 was there. So this Ind AS 16 is or I would say AS10 is a replica of Ind AS 16. AS10 is 95% cut copy paste of Ind AS 16, right? In 2016, AS10 was revised, and after revision, AS10 is kind of a parallel standard with Ind AS 16. If I talk about the standard from India perspective and from global perspective, in India, in accounting standard, it is AS10. In Ind AS, it is Ind AS 16. And in IFRS, it is IAS 16, International Accounting Standard 16. So this is how these standards are structured, right? So three standards, AS10, Accounting Standard 10, the title is Property, Plant and Equipment. Prior to 2006, the title was Accounting for Fixed Assets, and there was a separate standard on depreciation, which was a depreciation accounting on AS6. But on 30th March 2016, Ministry of Corporate Affairs demised AS6, and they have also amended AS10, and they have changed the title of AS10 from Accounting for Fixed Asset to Property, Plant and Equipment just to align with Ind AS 16, right? This Ind AS 16 was notified along with all the Ind AS standards, which was on 16 February 2015, right? And this IAS 16 is a global standard, which is a IFRS based standard. This IAS 16 is issued globally and is applicable globally. And now this Ind AS 16 is a big standard, and it is, it will be covered in two parts. It will be covered today and tomorrow. If I talk about the agenda of this standard, like any other standard, this standard also gives some objective and scope. So it is not written in the agenda, but this standard covers objective and scope as well. Every standard covers objective, every standard covers scope, right? Then we will be covering the recognition criteria in this standard. If I'll give you the journey of a fixed asset or a life cycle of a fixed asset or a property, plant and equipment, so what could be the life cycle of that asset? For example, you went to the Maruti showroom and you bought a car. First of all, the first thing which arises is how to recognize a car, whether we should expense it off in the P&L or we should recognize this as a property, plant and equipment, right? The first question comes, the recognition in the books of accounts, right? Whether you need to expense off or you need to take it to the balance sheet, I mean to say capitalize, right? So when I talk about recognition, it could be recognition initially and recognition subsequently. What does it mean? Initially means recognition at the transaction date. Okay. Recognition subsequently means recognition after the transaction date. For example, on 31st March. Let's say you bought a car on today is 16 October. You bought a car on 16 October. So you will recognize this car as a fixed asset in your balance sheet. Okay. On 31st March, what you will do? On 31st March, you will charge depreciation. On 31st March, probably if you are opting for revaluation model, you will revaluation, you will check the impairment, you will do the impairment testing. So this is about recognition. So when you bought a car, first thing comes, how is it going to be recognized? Number two, at what value is it is going to be recognized? Measurement. At what value it is going to be recognized? So we'll talk about the measurement criteria as well. In measurement criteria, we'll talk about elements of cost and measurement of cost, right? We'll talk about element of cost and measurement of cost. This is what we are going to talk about, right? Clear, friends? So then once you recognize, you are sure that you are confident that you are going to capitalize this as a PPE, property, plant and equipment. You have also you have also identified the values at which this PPE is going to be recorded. Now the third question comes, sir, once we recognize, once we measure, what happens on the reporting date? So on the reporting date, this is measurement after recognition, right? What you will do? Either you will continue with the cost model or you will revalue your fixed asset. Do you understand this cost model and revaluation model? I'm sure you must have covered these models in your AS accounting standard 10. I'm sure. Yeah, model and revaluation model. Okay, very good. We'll either continue with the cost model or we will do the revaluation, right? Then we will do the depreciation. We will charge the depreciation to compute the net block. Okay. So then depreciation is there. Of course, we'll be talking about what is the depreciable amount, what is the period of the depreciation, what is the method of depreciation, straight line method, WDB method, unit of production method. We'll talk all about that. Impairment. In case if the recoverable value has been gone down, right? Then we will charge impairment as well. Impairment also, right? So we'll talk about impairment. We'll talk about compensation for impairment. If someone is compensating the company for impairment, we'll talk about that scenario as well. So friends, we talk about recognition, which is birth of the fixed asset. Then we talk about the measurement, which is value of the fixed asset or PPE. Then we talked about the measurement after the recognition, after the first recognition and first measurement, right? So we'll talk about reporting date. Then end of the life cycle of the fixed asset, which is end of the life cycle of the fixed asset. What is the end of the life cycle of the fixed asset? Derecognition. Once your future economic benefit is not there from the fixed asset, your car is not able to run, right? Your car has already completed 10 years in case of diesel car in Delhi, or let's say your car has completed 15 years, probably you will not be able to run this car. So in that case, you have to derecognize, or you have actually sold out your car. You have to derecognize from your balance sheet. Then there are some disclosure requirement which we are going to adhere to. So this is what we will learn in this standard as a structure. So we'll cover this standard into 5 parts. One is recognition criteria, then measurement criteria, then आपका measurement after recognition, then we will be talking about derecognition and disclosure. We'll be covering this into 5 parts. Okay, right? I can see the presence of many students: Shankara, Ravi, Shailesh, Krishna, Shruti, Mansa, Viraj, Mukita, Sanisha, Vanshika, Pooja. Yes. Good morning, everyone. Once again. Objective of Ind AS 16. Why this Ind AS 16 was issued, right? And before discussing the objective, let me give you a view here, students. This Ind AS 16 is a kind of a this Ind AS 16 is a kind of a standard which is applicable in the balance sheet of Panwala to Reliance Industries Limited. Means every entity, if this entity has to run the business, they have some fixed assets. For example, when you went to your school, when you went to coaching center, you must have found some fixed assets around you. Can you give me some example of fixed assets? Can you give me some example of fixed assets? Yeah, furniture and fixture. Very good. Then projector, computer, laptop, refrigerator. Yes, television, building, land. Yes, motor vehicle, motorbike, cars. Okay, air condition. So many examples of fixed asset are there around you, right? I'm using my laptop, it is a fixed asset. I have kept my laptop on a table, which is furniture. I'm sitting on chair, which is furniture, right? So these all are fixed assets. These all are the examples of fixed assets. So fixed asset is kind of a standard. which is applicable in everyone's balance sheet, irrespective of the scale and size of the balance sheet generally. Number two, if this standard is applicable everywhere, then of course accounting policy will be there as far as the standard is concerned, right? Number three, understanding this standard is very, very, very important because this standard is applicable everywhere. Then you should know about the accounting, and then only you can audit these fixed asset standards, right? This audit the fixed assets using this fixed asset standard. Now coming to the objective of Ind AS 16, why this Ind AS 16 was issued, what Ind AS 16 caters about. Ind AS 16 prescribe the accounting treatment for PPE. You remember in one of my session I told you accounting means, what is meant by accounting? Accounting includes four pillars of accounting, which is RMPD, which is RMPD. What is RMPD? RM. Can anyone tell me the meaning of RMPD? Recognition, measurement, presentation, disclosure. Okay. So RMPD means recognition, measurement, presentation, disclosure. So friends, accounting does not mean only journal entry. Accounting does not mean only trial balance. Accounting includes your recognition, measurement, presentation, disclosure. Okay. So this standard prescribe the accounting treatment for PPE, for property, plant, and equipment, right? Standard also provides a recognition of the assets. This standard provides when an item has to be recognized as property, plant, and equipment. This standard provides that how you will calculate, how you will determine the carrying amount. Carrying amount means net block. The carrying amount means amount at which the PP is carried in your balance sheet. Depreciation charges. This standard also talks about depreciation charges. This is a only one standard, single standard, which covers capitalization as well as depreciation. You remember in the old days, in accounting standard, two standards were there, AS6 and AS10. AS6 talks about depreciation part and AS10 talks about other than depreciation, everything of fixed assets, right? But now, even in accounting standard, there is only one standard, which is AS10, and the title is property, plant, and equipment. Likewise, in Ind AS 16, there is only one standard which deals with the entire life cycle of the fixed asset, life cycle of the PPE, which is Ind AS 16. So this standard also provides your depreciation, about guidance about depreciation, what is meant by depreciation, what could be the method of depreciation, right? So how this depreciation is going to be charged, this standard talks about that thing also. Impairment. This standard also touches about impairment, although this standard says that if you have to charge an impairment, you have to refer the guidance which is given in Ind AS 36. You have to refer the guidance which is given in Ind AS 36 impairment of assets, right? So there is a separate standard in AS 36. Like in our accounting standard, we have read AS 28 impairment of assets. In Ind AS also, we have a separate standard Ind AS 36 impairment of assets, right? So this impairment in Ind AS 16, Ind AS 38, which is intangible asset, these impairments on fixed asset, intangible asset has to be, you know, measured, has to be calculated, has to be checked according to the guidance which is given in Ind AS 36, right? Okay. And we have covered the objective. Now let's quickly cover the scope. Ind AS 16 is applicable to all kinds of PPE, right? All kinds of PPE. So for whatever you see, whatever you feel, whatever you will tell me as a PPE, this standard is applicable. The negative list is given, right? The exceptions are given. Sir, what are the exceptions? Be classified as held for sale. If an asset has been classified as held for sale, you are still using the asset, but few conditions are meeting, you will be understanding, you will understand Ind AS 105, there is a separate standard, non-current assets held for sale and discontinued operation, right? you will understand few situations where the PPE has to be classified as held for sale. However, the company is using that PPE, the future economic benefit is there, but still it has been classified as held for sale. So if a PPE has been classified as held for sale, like building, if a building has been classified as held for sale, then Ind AS 16 is not applicable, Ind AS 105 is applicable. We will cover this part in detail in Ind AS 105, right? Biological assets related to agricultural activity. What is meant by biological asset? Biological assets means living animal or plant, right? Living animal or plant. This is the meaning of biological assets. So friends, biological assets is outside the purview of this standard. Why? Because there is a separate standard, Ind AS 41, which takes care of biological assets, right? Related to agricultural activity. But in biological asset, there is a concept of bearer plant. Bearer plant. What is meant by bearer plant? Bearer plant are those plant which bears fruits and vegetables for more than one period, like more than 1 year. Mango tree. Mango tree gives mangoes for more than 1 year. Banana tree gives banana for more than 1 year, right? Tea, coffee, tea tree, coffee tree, they have a life of more than 100 years. Tea tree, coffee tree bears tea leaves, coffee leaves for more than 1 year, right? So friends, these plants are known as a bearer plant, and bearer plant is within the scope of Ind AS 16, but biological assets other than bearer plant are outside the scope of Ind AS 16, right? The third one, which is recognition and measurement of exploration and evaluation assets. Recognition and measurement of exploration and evaluation assets means, for example, Adani is into mining business, Vedanta is into mineral resources business, right? So these companies are digging mines and they are extracting mineral ores, right? They are extracting mineral ores, right? So that recognition and measurement of exploration and evaluation assets, right, is covered under Ind AS 106. It is not covered under Ind AS 16. Mineral rights and mineral reserves such as oil, natural gas, and similar non-regenerative resources is also outside the scope of Ind AS 16. But if the company like Adani, Reliance, Vedanta, they are using cranes for extracting the iron ores, mineral ores, right? They are using cranes for extraction. So the assets which is help, the asset which is used or which is helping in such items will be covered under Ind AS 16. So that exploration and evaluation of mineral resources is not covered under Ind AS 16, but the assets which are getting used for extraction of those mineral resources is covered under Ind AS 16. Like crane is covered under Ind AS 16. Like truck on which these minerals are loaded, these trucks are covered under Ind AS 16. I hope it is clear to everyone. Part. I hope it is clear to everyone. Shankara is asking, sir, can you please explain the term PPE held for sale with an example? Shankara, although we will discuss Ind AS 105 in detail as a separate standard, as a separate session, but let me give you a thought right away. For example, TCS has purchased 5 cars for their senior level employees, right? TCS, you know about TCS, Tata Consultancy Services. It's an IT company. So they bought 5 cars for their senior employees. Their senior employees didn't like that Maruti car, right? So now TCS decided to sell those cars. Okay, TCS decided to sell those cars. So when the TCS decided to sell those cars, right, there are few conditions which is given in Ind AS 105. So when TCS decided to sell those cars, these cars will be classified as held for sale. Although TCS has not yet sold the car, they have decided to sell the car. So after meeting few conditions, these car will be classified as held for sale, and the depreciation will be stopped on these cars, right? And when this car will be classified as held for sale, it will cover under Ind AS 105. It will not be covered under Ind AS 16. So just to give you a thought, sir, what are those conditions? Those conditions we will be discussing in detail in Ind AS 105. For the time being, students don't get confused. For the time being, just remember, if any PPE is classified as held for sale, then it will be outside the scope of Ind AS 16, right? So when you will complete your financial reporting course, you will be able to understand that what is held for sale, what is Ind AS 105. Okay, guys? But just to give you an example, you can remember this TCS and car example. Definition of PPE, guys, most important part, right? Definition of PPE. What is PPE? Can you see PPE? Can you touch PPE? Yes, yes. You can see PPE, you can touch PPE. Like land, you can see, you can touch building. You can see, you can touch, right? Furniture. You can see, you can touch laptop, computer. So PPE are those items which you can see with your pair of eyes, which you can touch. It means PPE are intangible. PPE are tangible assets. Sorry, PPE are tangible assets. So what is PP? PP a tangible item. Tangible item what? Which are held for use. Tangible item which are held for use. Use where? Either in production, right? Like machinery. Machinery is used in production. Or supply of goods like truck, delivery van, right? Or rental, like if I talk about these JCBs, have you heard about JCB? They are having cranes, JCB. So JCB is providing their crane on a rental basis, right? When you go to the construction site, you will find a lot of machineries, right? For mixing of material, for uplifting of material. These all machineries are on a rental basis. So one can use the machineries for their own production. One can use the machinery for giving it on a rental basis to earn rentals, right? So PP are tangible items which are held for use in either production or supply of goods and services or for rental purposes or for administrative purposes like laptop computer. These are for administrative purposes. These are helping the employees to execute their tasks, right? Your refrigerator, office equipment, table, furniture, chairs, projector, these all are for administrative purposes. Your chair is not used for production. Your chair is not used for supply. Your chair is not for rental purposes, but these are for administrative purposes, right? So tangible item which are held for number one, production, number two, supply of goods and services, number three, rental, number four, administrative purposes. So if a tangible item is held for use in production, supply, rental, or administrative services, and the life of this tangible asset is more than 1 year, expected to be used during more than one period, technically means more than 1 year, right? So this is the definition of PPE. Friends, a company has bought a software, and that software will help the company to maintain their accounting related records, right? And the life of the software license is 3 years. Is it a PP? Whether the software is a PP, whether the software is a PP. Friends, I hope I'm clear and loud. I'm audible properly. I hope I am audible properly, friends. Am I clear and loud? Yeah. So I am asking whether software is a PP. Why it is not PP? Why the software is not a PP? Software is not PP because It is an intangible asset. Software is an intangible asset, and that is why it is not a PPE. Software is not a PPE, right? Because it is an intangible asset. Software is an intangible asset, and that is why it is not a PPE. Software is not a PPE because it's an intangible asset. Okay? Software is an intangible asset, and hence it is not a PPE. Just give me a minute. Just give me a minute. Yes, I hope I'm audible now properly. Software is not a PPE because it's an intangible asset, right? It's an intangible asset. Okay. Second example, a company has bought a building. A company has purchased a building for the purpose of earning rental. So the sole objective of the company was to provide this building on a rental basis, right? Provide this building on a rental basis. Whether this building will be classified as a PPE, whether this building will be classified as a PPE. Few are saying yes. Rahul is saying no. Why, Rahul, you are saying no? Krishna is saying, sir, PPE rental is covered under PPE and more than 1 year. So let's check this building. Let's check the three condition of this building, right? Number one, whether it is PPE or not. Number one, PPE should be a tangible item. Whether building is a tangible item, whether building is a tangible item, answer is yes. Number two, that assets should be held for use in the production. Whether building is used in the production, answer is no. Whether it is used in the supply, answer is no. Whether it is for administrative, answer is no. Whether it is for rental, answer is yes. Whether the life of the building is more than 1 year, expected to be used during more than 1 year, answer is yes. So all three conditions have been met. So now, whether building is PP, answer is no. Building is not PP if it is held for rental purposes. Sir, why? Friends, there are two exceptions of this rental. Please write down. Please write down. There are two exceptions of this rental. What are the two exceptions of this rental? Land and building. If land and building is held for, if land and building is held for earning rental, it is not PPE, it is considered as an investment property. You will read Ind AS 40. We will discuss Ind AS 40 over the weekend, right? So Ind AS 40 is applicable to land and building, only two assets, land and building, which is held for rental purposes, which is held for earning rental, right? So friends, the exception to this definition is only two assets, land and building, which is held for rental purposes. Sir, if the company has acquired a building and that building is for, and the company is using that building for factory purposes, the company has installed its machinery in that building. In that case, of course, this building is a PP. This building is a PP, right? The land and building which is only held for earning rentals, that has to be classified as investment property. Okay? That has to be classified as investment property. Is it clear? Please write down. Land and building which is held for earning rental will be covered. Land and building which is held for earning rental has to be covered under Ind AS 40 investment property and not Ind AS 16 PP. Is that clear? Is that clear? Sir, what happens if a company is providing or giving a machinery on a rental basis? Right? You remember? So nowadays, have you heard about Lakshmi Nagar area? Lakshmi Nagar? Lakshmi Nagar is an area which is in Delhi.
It's called as a CA's area. So a lot of CA students, you find a lot of chartered accountant and CA students there in Lakshmi Nagar. Now what happens in Lakshmi Nagar? So there is a shop. For example, you are a student and you need a laptop for a month, right? The laptop will cost you 50,000 rupees. But you can go to that shop and got a laptop on a rental basis, and they will charge you rental per month for, let's say, 5,000 rupees or 6,000 rupees, right? So these companies, or I would say this entity, is giving the laptop on a rental basis. So whether laptop is PPE for them, answer is yes, laptop is PPE for them. Laptop is property, plant and equipment for them, right? But in Lakshmi Nagar, there are some building and the landlord is giving that building on a rent basis, on a lease basis. Whether that building is a PP, answer is no, that building is investment property covered under Ind AS 40. Is that clear, friends? Is that clear? Do you have any doubt? Nisha, is that clear? Krishna, is that clear? Sarvananan, Pooja. So there is an exception, right? And what is the exception? Land and building held for rental purposes. Land and building held for rental purposes has to be covered under Ind AS, has to be covered under Ind AS 40. This is an exception. Why? Because there is a separate standard. There is a separate standard on land and building held for rental purposes, right? Okay, friends. So we have covered this definition. Please remember, tangible item held for use in production or supply or rental or administrative purposes and expected to be used for more than 1 year will be classified as property, plant and equipment. Do let me know if you have any question, if you have any doubts so far. Everything is clear in mind? Very good. XYZ Limited. Let's quickly do this case study. XYZ Limited has acquired a land to construct a plant for manufacturing of goods. So they have acquired a land to construct a plant, to construct a factory. This land is not for earning rental. This land is for construction of factory. Whether this land is a PP, whether this land is a PP, you need to tell me. Machine A, also they have acquired below item for the business. Machine A for the production. Machine A for production purposes, right? So they have acquired machine A for production purposes. Machine A for production purposes. Building for rental purposes. Truck for transportation of goods. Furniture and fixture for office administration. C. Production, supply of goods and services, administrative purposes, right? Although this is rental purposes, but it is a building. Laptop for the employees for office working, again administrative purposes. SAP software for maintaining records and books of account. Identify whether above items are PP or not. Now you need to tell me quickly whether these items are PP or not. Land is a PP, right? Land is a PP. Machine A or plant, right? Plant is a PP, machine is a PP. In this case, the land which is acquired for construction of plant is a PP. Plant is also PP factory. Machine is a PP. What next? After machine, building, whether building is a PP. Whether building is a PP. Building is not a PP. It is the investment property covered under Ind AS 40. Truck for transportation of goods. Yes, it is a PP. Feature and picture. It is a PP. Laptop. It is a PP. Software. It is not a PP. Why? Although it is meeting the second and third definition, second, third leg of definition, but it is not meeting the first leg of definition, which is tangible item. Software is an intangible item. Clear? Shall we move forward? Okay. Now, friends, we understood the definition of PPE. We understood the definition of property, plant, and equipment, right? Now, let's discuss the recognition criteria. Recognition criteria means if you have purchased, if you have invested, if you have, spent your money to acquire some item, whether it is a PP or it is not a PP. So, for recognizing an item as a PP, number one, it should meet the definition of PP. It should be intangible. It should be a tangible item. It should be held for use in production or supply of goods and services, or for rental purposes, or for administrative purposes, and to be held and to be expected to be used for more than 1 year, more than one period. The exception is if land and building is held for rental purposes, it is not a PPE, it is an investment property. Coming to the recognition criteria. What is a recognition criteria? Recognition criteria is FC. Recognition criteria is FC. What is meant by FC? FC means fixed cost, right? Sir, FC means fixed cost? Yes. Here FC means future economic benefit is probable. Future economic benefit is probable and cost can be measured reliably. There are two recognition criteria. Friends, for recognizing any asset, you remember when you have covered the conceptual framework for financial reporting, when you have covered the conceptual framework for financial reporting, the faculty has taught you two criteria for recognition of asset in addition to control. The first criteria is future economic benefit. If you are recognizing an asset, right, you are not expensing of the asset, you are recognizing an asset. So you will recognize the asset only when the future economic benefit is probable. The definition, even the definition of asset is a resource controlled by the entity which provides the future economic benefit in future, which provides a future economic benefit associated with that asset. So the first condition is future economic benefit should be probable. Probable means there are high chances, there are more than 50% chances that when you will use that asset, you will get a future economic benefit. And cost can be measured reliably. For example, when you purchase a machine, what is the future economic benefit you will be getting out of that machine? What is the future economic benefit you will be getting out of that machinery? Output, production of goods, output, right? This is what you will get from the machine, right? If you purchase a truck or a delivery van, what future economic benefit you will get out of that? You will be getting out of that truck or that delivery van or that motor car. Delivery of goods and services, delivery of goods, right? You have purchased a furniture, you have purchased a laptop. What future economic benefit you will be getting out of that? Of course, when you will be using that asset, it will help you in administrative purposes, right? If you will not maintain your accounts, probably whenever there is a raid from the regulatory authorities, they will seize your business, because maintaining a books of accounts is a compulsory requirement under Companies Act. If you will not maintain your books of accounts, how will you deposit your taxes? How will you finalize your balance sheet? How will you file your balance sheet to the taxation authority, to the Companies Act, right? Even when you go to theater, you must have seen fire extinguisher, right? Fire extinguisher, air purifier. So what are these things? Even these things are going to be capitalized. The fire extinguisher does not give you a future economic benefit, but it ensures that if any mishap will happen, if any fire will happen, so this fire extinguisher will be used for safeguarding the assets of the company, right? So that it will blow the fire, it will down the fire, and it will safeguard the assets of the company, right? So even this safety equipment are also covered under Ind AS 16. Why? They are not directly giving the future economic benefit, but they are used in the future economic benefit to be provided in future, right? How it will be provided in future? If any mishap will happen, this fire extinguisher will be helping in protecting the assets. Okay, in protecting the assets. So friend, economic benefit should be probable and cost can be measured reliably. I am giving you one example and you need to tell me whether this item needs to be recognized as a PP. A company has ordered a machinery from China. When the company got the delivery, when the company got the delivery of that machinery in its factory premises, the government has banned the output. The government has banned the output, which is the outcome of that machinery. जैसे मशीन फैक्ट्री में आई, वो मशीन जिस आउटपुट का प्रोडक्शन करती, गवर्नमेंट ने वो आउटपुट ही बैन कर दिया, उसके ट्रेडिंग और मैन्युफैक्चरिंग दोनों बैन कर दी. Will you capitalize this machinery as an asset? Will you capitalize that machinery as an asset? Will you recognize the depreciation over the period of machinery? Tell me what you will do. Will you do that? Will you do that? Will you capitalize the machine as an asset? Guys, everyone is saying no. Ravish, Munish, Mufita, Preeti, Rahul, Ridvik, everyone is saying no. Fantastic. But why no? Why no? It is a tangible item. It is held for use in the production or supply of goods and services. The life is more than 1 year. So that is a definition. By the definition, it is a PP. But the second filter, which is recognition condition, it says that future economic benefit should be there. Since government has banned the output, although machine can produce that output, but what the entity will do with that output? Because the government has already banned. So there is no future economic benefit arising out of that machinery. There is no future economic benefit, and hence this machinery does not satisfy the condition of recognition as a PPE. So in this case, the entity has to record a loss from that machinery. The entity has to, immediately impair that machinery. Okay, as no future economic benefit is there. I hope it is very well clear to all of you. What are the two conditions, guys? FT, future economic benefit is probable, and the cost can be measured reliably. So normally the cost can be measured normally, but you need to look at the future economic benefit. Sir, in the big factories and plant, we have seen that there are some spare parts, there are some standby equipments, and there are some servicing equipment. Like when you purchased a car, how many wheels are there in the car? How many wheels? Four. Four wheels are there in the car. But you will get one Stephanie as well. You will get one Stephanie as well. You remember one Stephanie? One additional tire, one additional wheel. Whenever you have a problem, your one of the tire get deflated, you will replace that tire with that Stephanie. What is that spare part? What is that standby equipment? Standard says that the spare part, standby equipment, and servicing equipment. So that has to be, just give me a second, friends. Yes. So friend, standard says that spare parts, servicing equipment, standby equipment is recognized as a PP if it met the recognition criteria and definition of PP, right? If spare part is a tangible item, answer is yes. If spare part should be used in the production, held for use in production, answer is yes. Because when the spare part will be used in the machinery, it will be used in the production. Number three, expected to be used for more than 1 year. If the spare part, the life of the spare part is only 2 months, 3 months, in that case, it is not meeting the definition of PP. There are some spare parts like greasing oil, lubricants, right? Your bearings. There are some spare part which has to be changed at a regular intervals. For example, at after every 100 hours, the machinery requires to be, replace its oil filter. So let's say there is a air filter and oil filter in the machinery, which is a very, which is not a very expensive item. Let's say the value of that item is 1,000 rupees, 5,000 rupees, and that item has to be replaced on a regular interval basis. So, and the company is keeping the records and the company is keeping the stock of these kind of spare parts in its godown. So, friends, the life of the spare part is less than 1 year. In that case, it will not be capitalized. It will not be considered as a PP. So, just to cut a long story short, the spare part standby and servicing equipment will be recognized as a PPE if it met the definition and recognition criteria of PPE. Future economic benefits should be probable and cost can be measured reliably. So if that spare part will be used, for example, it's Stephanie, when the Stephanie will be used in the car, of course it will make your car running, right? If one of the tire is deflated, the Stephanie will be helpful in maintaining the car, in running the car. Have you got it? Sir, what happens? What about the air filter, oil filter, which you told, which requires a replacement at a regular set of intervals? In that case, it has to be considered as an inventory, right? Spare parts, standby equipment, and servicing equipment will be capitalized as a PP if it met the recognition criteria and definition of PP. Otherwise, it will be an inventory. Otherwise, it will be an inventory under Ind AS 2. Right? Is that clear? Is that clear? Any doubt so far? Any question, any doubt? We understood that the PPE has to be recognized as a PPE, means any item needs to be recognized as PPE. Number one, it should meet the definition of PPE. Number two, it should meet the recognition criteria. Means when you are using that item, when you are using that asset, you will have some future economic benefit. Right? Okay, friends, let's move on. Subsequent cost. Now, we understood the recognition criteria. For example, there is a truck. When you purchase the truck, of course, it will provide a future economic benefit. The cost is measured reliably, and the truck is a PP because it is a tangible item. It is held for use in the production or supply of goods and services, or for rental purposes or for administrative purpose, and life is more than 1 year. So initially, the truck is recognized as PPE. Okay. And Ind AS 16 will be applicable. Now what happens? After 6 years, the life of the truck is, let's say, 15 years. After 6 years, the engine of the truck got damaged. Engine, right? And if the value of the truck is 20 lakhs, let's say, the engine will cost around 10 lakh rupees or around 5 lakh rupees, whatever it may be, but a huge cost. but a substantial or significant amount, which is the value of the engine. Now, friends, the question arises, truck we have capitalized as a PPE. It is very much clear. There is no doubt about that. After 5 years or after 6 years, let's say, if this company is replacing engine, I mean to say that company is buying a new engine and installing it in the truck, right? Now the question arises whether the subsequent cost is going to be capitalized. The subsequent cost, the huge subsequent cost will be is going to be capitalized. Before answering this question, let me give you a guidance which is given here. Standard says that the recognition criteria for initial cost and subsequent cost is same. The recognition criteria for initial cost and subsequent cost is same. So what is the recognition criteria? Future economic benefits should be probable and cost can be measured reliably. Are we aware about the cost of the engine? Answer is yes. Whenever you are dealing with an external party, of course, whatever you will purchase, the party will raise an invoice, the party will demand a payment. So cost will be measured reliably always. Number two, future economic benefit. After installing this new engine, whether this will give you a future economic benefit? Answer is definitely yes. The engine of the truck got damaged and now this truck is not able to run on the ground, on the roads. So to make it a roadworthy, this engine is required. So when the remainder of the truck is perfectly all right, just when you put a new engine, the truck will start running. Future economic benefit is there. Answer is yes. So friend, standard says that same criteria needs to be followed as of initial recognition. It has to be added in the carrying amount of PP if recognition criteria is met. Sir, in this case, the recognition criteria is meeting. Are you saying that in this case, this engine has to be capitalized with the truck? Don't you think? For example, the value of the truck was 20 lakh rupees and the value of the engine is 5 lakh rupees. Don't you think when you add this engine to the truck, it will be 25 lakh rupees? Answer is yes. Sir, don't you think that truck is already having one engine? So when we purchase a truck at 20 lakh rupees, it also includes a component of an engine? Answer is yes. Sir, when you add this engine to the truck, don't you think that the two engine will be capitalized? Answer is yes. Sir, don't you think this is wrong? Answer is yes. इसमें भी answer yes है. So friends, in this case, the new engine is going to be capitalized and the old engine is going to be derecognized. Sir, but how can we aware about the cost of the old engine? Because when we purchase a car, of course, engine is a part of the car. Tires are the part of the car. But whenever we got the invoice, we didn't get the invoice, which also reflects the value of the engine. In invoice, the value of these components are not there. Only the value of the car is there. So how do you de-recognize that? I'll tell you, right? But for the time being, number one, the recognition criteria is same for subsequent cost also, which is future economic benefit and cost can be measured reliably. If the recognition criteria is meeting, that subsequent cost is going to be capitalized. Right? Number two, if the subsequent cost is going to be capitalized, the initial cost is going to be de-recognized relating to that component, right? Sir, in this case, the air filter, oil filter, day-to-day servicing costs, this is also giving the future economic benefit. If the machine is not maintained, it will not be able to provide the output. But do you think that day-to-day servicing, greasing, labor, consumable, air filter, oil filter, this is meeting the definition of PP? Answer is no. at least that component, that part should have a life of more than 1 year. And it should be a significant amount, right? The next part standard says that it can be in the form of replacement cost, major inspection, major overhauls, right? So subsequent cost you are going to capitalize if it is significant, like major replacement, right? Like major overhauls, major maintenance, major inspection. So these are going to be capitalized. These are going to be recognized as a part of the cost of the asset. Is that clear? Is that clear, friends? Is it clear or not clear? Clear? Okay, friends. So let's go to the Excel file, and there I'll discuss the practical part of it. I hope my Excel file is visible. Is it visible? Okay. And in India 16 PP, we have covered the agenda, we have covered the objective, we have covered the scope in the PPT. Definition of PP, we have covered PP as a tangible item, which is held for use in production or supply of goods and services. It is held for rental purposes, it is held for administrative purposes, and it is to be used for more than one period, which is more than 12 months. What is the exception? Land and building held for rental purpose is covered under Ind AS 40 investment property, not under Ind AS 16. This is what we read. This is what we understood so far, right? Recognition criteria. An item will be recognized as PP if below two conditions will be satisfied. Future economic benefit is probable, cost can be measured reliably. Recognition criteria is same for initial cost as well as subsequent cost. Initial cost as well as subsequent cost. Subsequent cost. What is meant by subsequent cost? Subsequent cost is like major replacement, overhauls, and major inspections are capitalized or recognized as a PP if the recognition criteria is satisfied. Day to day, small repairs, service cost, etc. are charged to the P&L. This is what we have read so far. Munish, I'll explain that. Don't worry about that. The re-recognition of engine, I'll explain. Right? So that is why I have taken you guys to the Excel file. Now, the subsequent capitalization and de-recognition of the existing component, I'll cover here, and I'll discuss with the help of an example. Example. The company has purchased a truck for 20 lakhs on 1st April 2015. The company has purchased a truck for 20 lakh on 1st April 2015. Life of the truck is 10 years. Life of the truck is 10 years. On 1st April 2020, that is after 5 years, the company has replaced the engine of the truck for rupees 5 lakh as it became faulty and the truck was not able to run. 1st April 2015, when the truck was purchased, whether it was including engine or it was excluding engine. On 1st April 15, when this truck was purchased, whether it was including engine or it was excluding engine. Sir, which kind of question is this? Of course, this is an including engine. Sir, आप सवाल ही कैसा कर रहे हो? ये तो including engine है. First April 20, one engine has been purchased on replacement and same needs to be added to the cost of the truck. Right? It is meeting the definition of PP. It is also satisfying the recognition criteria. It is also satisfying the recognition criteria. Okay. Now, should I say the gross block? Should I say the gross block of the truck is equal to 20 lakh plus 5 lakhs? Should I say the gross block of the truck is 25 lakhs? Can I say this? The initial cost of the truck was 20 lakh, right? After 5 years, 5 lakh engine was installed. So now the value has become bigger. Now the value has been increased for this truck, the gross block. What do you say? This is wrong. This is not right. This is wrong. Why? A truck has one engine. A truck should have one engine. But in this case, the truck should have two engines, right? If I'll add 5 lakh and 20 lakh, it seems that the truck will have one engine at a time, but two engines have been capitalized in the fixed asset register. So this is wrong. This is not right. This is not right. This is wrong. Right? This is not right. Why? Because because a truck can have only one engine. This is not right because a truck can have only one engine. Right? So in this case, the value of the old engine needs to be de-recognized, decapitalized, de-recognized. Sir, how to de-recognize? How to de-recognize old engine? How to de-recognize old engine? So let me tell you how to de-recognize the old engine from PP. Because you need a value. And when you bought a truck, you don't, you are not aware about the value of the truck. Sorry, value of the engine separately. You are only aware about the value of the truck. Friends, now standard says that how to arrive at a value to de-recognize the old engine. Number one, if value is identifiable at the time of the purchase, if value is identifiable at the time of purchase, use that value for de-recognition. For example, when you bought a truck, you are aware that the cost of the engine built in the truck is, let's say, 6 lakh rupees. In that case, it is a major component, right? In that case, if you are aware about the value of the truck, value of the engine at the time when the truck was purchased, you can use that 6 lakh rupees at the beginning, and whatever is the carrying value, because of course this value has also been depreciated ना. आपने 20 लाख को 10 साल का अगर लाइफ था तो 5 साल में डेप्रिसिएट कर चुके हो, तो इंजन कंपोनेंट भी तो डेप्रिसिएट हो गया होगा ना. So while calculating the carrying value, you could have taken 6 lakh as the opening value for the engine. But in this case, you are not aware. So standard says that if the value is not identifiable, use the current value. What is the current value, sir? 5 lakh. But today's 5 lakh, whether today's 5 lakh is equivalent to the 5 lakh 5 years before? Answer is no. So it means if today you are investing 5 lakh rupees, it means 5 years back, the value is lower than this 5 lakh rupees as of today. So standard says that if value is not identifiable, use the current value and discount it to the date of original purchase. Arrive at the original value for de-recognition. Arrive at the original value for de-recognition. Right? Sir, please explain this with the help of the numerical example. Let me explain you here. Let me explain you here. What is my current cost? My current cost is 5 lakh rupees. What is my discount rate? My discount rate assuming 10%. I am assuming 10%, right? 10% discount. How much time period has been elapsed? 5 years. So present value factor 5 years back. What is my present value factor 5 years back? 5 lakh divide by 5 lakh divide by 1 plus 10%, 10% to the power 5. Right? Is that clear? So if today the value is 5 lakh rupees, what should have been the value 5 years back for this 5 lakh rupees? It is 3 lakh 10,461, right? If you would have invested 3 lakh 10,461 5 years back, at an interest of 10%, it become 5 lakh rupees. This is what it is there, right? So present value factor, your present value factor, here I have just computed the value. Let me compute only present value factor. My present value factor is how much? 0.621. 5-year present value factor is 0.621. What is my estimated value of engine? Estimated value of engine in the beginning. It is 5 lakh multiplied by 0.621. 310461. 310461. Right? This is estimated value of engine in the beginning. Now, friends, I got the estimated value in the beginning. Now I need to compute the carrying value. This is my truck. The total cost of the truck at the time of purchase. My total cost of the truck at the time of purchase was 20 lakh, right? Now I have two components. I got the estimated cost of engine. Estimated cost of engine is how much? 3,10,461. Remainder of truck means that all other parts other than engine. How much it is? 20 lakh minus 20 lakh minus 10,461. Lakh, right? This is my beginning. This is my gross block. Are you able to understand this? What I have done? I have splitted. मैंने टुकड़े कर दिए 20 लाख रुपए के. I have splitted 20 lakh into two parts. Engine value and मैंने इंजन की वैल्यू कैसे निकाली? Whatever is the replacement cost today, if I'll discount it 5 years back, what was the value at that point of time? Avish, I'll answer your question later on, but as of now, we are discussing there is a single truck where we are replacing one engine. Replacing one engine means putting a new engine and discarding or scrapping the old engine, right? We are talking about that. Gross block, you all understand or you haven't understand? Simple. What is a life? What is the life of the truck? Life was 10 years, na? The life was 10 years. It means so far the depreciation would have charged. The depreciation would have charged on the basis of life of 10 years. Accumulated depreciation. Then there is your accumulated depreciation. What is your accumulated depreciation so far? 310,461 divided by 10 multiply by 5. Right? Again, this divide by 10 multiply by 5. So technically it should be 10 lakh rupees in the 5 year. Technically 10 lakh is there. So I have calculated the accumulated depreciation also. Now what is the carrying value? What is the carrying value as at 31st March 2020. What is my carrying value? Is that 31st March 2020? Right? The carrying value is total 10 lakh rupees. For engine, it is 1,55,230. For truck, other than engine, 844,770. These are the values on the date of replacement of engine. Are you guys comfortable with this? Please do let me know. Are you guys comfortable with this? Any doubts so far? How I have arrived at the estimated value of the engine in the beginning? Yeah, everyone is saying, got it, sir. Very good. Now, friends, let me make you guys understand the accounting entry for this. So I'll write the accounting entry straight away from the beginning. Okay? Accounting entry. You guys need to quickly help me in drafting the accounting entry. Tell me the accounting entry at the time of purchase. Accounting entry at the time of purchase of truck. Purchase of truck. Right? 1st April 2015. Tell me the accounting entry at the time of purchase of truck. PP truck account debit to bank account simple. PE truck account debit to bank account. PP truck account debit, bank account credit. How much? 20 lakh. Right? Now you need to charge depreciation. Depreciation. What is the depreciation? So depreciation you have charged from 2015-16 to 1920, 5-year depreciation you have charged, right? What is the accounting entry? Debt to accumulated debt. Depreciation account debit, accumulated depreciation or PP account. Depreciation account debit to accumulated debt oblique PP account. How much depreciation have been charged so far? 10 lakh rupees depreciation have been charged so far. Right? Now, 31st March 20 replacement. 31st March 20 replacement. What accounting entry you need to pass for replacement? What accounting entry you need to pass for replacement? On 31st March 20, you have the two values. So PP truck other than engine is 844,770. PP engine is 155,230. Right? First of all, you have to pass purchase of new engine at the time of replacement. At the time of replacement, what you will do at the time of replacement? You will capitalize the new engine. What is the accounting entry for capitalizing the new engine? Truck. Engine account debit. Engine account debit. How much? 5 lakh rupees. To bank account. Credit. Right? Truck. Engine account debit to bank account. Now derecognize the old engine. Derecognize the old engine. How to derecognize the old engine? How to derecognize the old engine? You need to credit to old engine. What is the value of the old engine? What is the value of the old engine? You remember when you capitalize the old engine, the estimated value was 3,10,461. This is your gross block. This is your gross block. Old engine, this is your gross block, right? Accumulated depreciation debit. Accumulated depreciation account debit. How much? So on this estimated value of engine, the original cost was 310,461, the derived cost. The depreciation so far has already been taken at 155,230. Assuming you will not receive any value from the sale of the scrap engine, assuming. So where the difference will go? The difference will go to the loss on replacement. Loss on replacement. 155,230. Loss on replacement 155,230. Sir, what happens if, for example, the old engine sold at 50,000 rupees as a scrap value, right? Because in practical scenario also, normally what happens, if you will sell such a big engine, you will get some scrap value, or the dealer who will giving you the new engine. For example, if you are purchasing a new battery, you can sold your old battery at 200 rupees, 500 rupees or 1000 rupees. Sir, what happened in that case? In that case, again, same and accumulated depreciation account debit, you will debit, you will reverse the accumulated depreciation, whatever you have booked so far, right? You will also credit your old engine with the gross block. Yeah. Okay. And you will also pass an bank account debit because you got 50,000 rupees on the sale of scrap. Okay. Now, what is the total? Just take the total here. So, how much is the difference? This minus this 105,230. 105,230. This will be your loss on replacement. This will be your loss on replacement. You can see your loss on replacement will reduce by your loss on replacement reduced by 50,000 rupees. Why? Because there is a scrap value. This engine has been sold at a scrap value of how much? How much? 50,000 rupees. This is what it is. This is what it is. Friends, please let me know if you have any doubt in understanding these entries. So I have given you the chart of this depreciation chart and everything. And I have also given you these accounting entries. Please let me know if you have any doubt in understanding these accounting entries. Please let me know if you have any doubt in understanding these accounting entries. Please let me know. At the time of purchase, depreciation, replacement, recognition. I hope it is clear to all of you. Yeah. Tanisha is asking a question, sir, why didn't we recognize the engine separately from the beginning itself? Since the company very well estimate the life of the truck and engine, Tanisha, you are bang on. You are absolutely all right. You are absolutely right here. You know what happens like in case of a aviation industry. First of all, Tanisha, accounting standard in India talks about component accounting. What is a component accounting? Component accounting means recognizing and capitalizing the major component of a particular asset separately in the fixed asset register. For example, when you bought a car, you can capitalize tires if they are significant, engine, and the remainder of the car. Like a car is the total value is 10 lakh, but it has to be splitted into the sub parts of three: engine, tire, and other than and the remainder of the car, right? So likewise, all the aviation industry, if you will see the annual report of SpiceJet, if you will see the annual report of Indigo Airlines, which is Interglobe Aviation, you will find they are also bifurcating their aircraft into various components like inspection, engine. So they are also splitting. And you're right. In this case, if you are well aware about the estimated value and the time, you can you can show it separately since beginning. You can show it separately since beginning. But generally, what happens, Tanisha, generally you don't have the value of those components separately. You don't have the value, right? So it would be difficult to estimate what is the value. And that is why the companies are capitalizing upfront as a one asset in the beginning. But what happens if this engine would have replaced after 10 years, the life of the truck was 10 years, और इंजन भी 10 साल के बाद रिप्लेस करना पड़ता, तब क्या कोई प्रॉब्लम होती? देन देयर इज नो एनी प्रॉब्लम. व्हाई? Because the truck has been fully depreciated in the 10 years. Truck fully depreciated हो चुका होता. So in that case, whenever we bought the engine, we will capitalize as it is. यहाँ पर the expected life was 10 years, but this engine got damaged, and in between we need to capitalize a new engine. And that is why we need to estimate what was the value so that we can arrive at a carrying value at the time of replacement, right? But you guys are absolutely right. If you can estimate the value, you should do the component accounting. You should present or show the major component of an asset separately, right? For example, if there are two major component of a particular asset, you can just capitalize those two component, and the remaining value will go to the remainder of the asset, right? The remaining value go as a residual approach to the remainder of the asset, right? And in that case, you know what happens? If let's say on the day one, you estimate that the life of the truck is 10 years, but the engine which is inbuilt in the truck, it is only having a life of 5 years. In that case, you need to capitalize separately, means total truck, then sub parts are engine and the remainder of the truck. The remainder of the truck has to be depreciated on the life of 10 years. The engine has to be depreciated over the life of 5 years. So friends, India says that when I'll tell you the depreciation in the next class, even I'll touch this concept as well. That if an aircraft, or I would say if an asset has a different part which is having a different life, those parts needs to be capitalized separately. अगर लाइफ डिफरेंट नहीं है तो प्रॉब्लम नहीं है, बट इफ द लाइफ इज डिफरेंट देन दोज नीड्स टू बी कैपिटलाइज सेपरेटली, राइट? Friends, it's 8:23 now. Let's have a break of 5 minutes, or let's say 7 minutes. It's 8:23. We will start at 8:30, right?
Let's cover illustration number 8.
MS Limited has acquired a heavy machinery at a cost of rupees 1 crore 100 lakhs with no breakdown of the component parts. The estimated useful life is 10 years. So the total cost is given, which is 1 crore. The estimated useful life is 10 years, which is given. At the end of the 6th year, means after 6th year, one of the major component, the turbine, requires replacement as further maintenance is uneconomical. So they found that if they want to go for if they want to go for repairing this turbine, so this will be a very huge cost. This will be a very expensive affair. So they decided that let's replace the turbine. The remainder of the machine is perfect and is expected to last for the next 4 years. Right? The cost of the new turbine is 45 lakh rupees. The discount rate is assumed 5%. Can the cost of the new turbine be recognized as an asset? And if so, what treatment should be used? So now, with this information which is given, there is a machinery, heavy machinery. The total cost is 1 crore. The useful life is 10 years. But after 6 years, one of the turbine require replacement. Turbine is an important component in this entire machinery, right? And the new cost of the turbine is 45 lakh rupees. Discount rate is 5%. First question, can the new turbine be recognized as an asset? For answering this question, you have to ask, is it a PP? Answer is yes. Number two, whether the recognition criteria is satisfied? Answer is yes. Number one, future economic benefits should be probable? Answer is yes. If this turbine would not be replaced, the machine would not be able to run. Number two, cost is measured reliably? Yes, we are aware about the cost. So if I evaluate from the perspective of the recognition criteria and the definition, yes, the new turbine will be capitalized as an asset. And if so, then what treatment should be used? How will you, what sort of accounting treatment you will do? How will you arrive at the derecognized part of the turbine? How will you replace that part? So what you will do? Because in the beginning, only 1 crore of the value is given, which is for the entire machinery. There is no separate value of the turbine, but in the question, the discount rate is given in the question, right? So this is what which is given in the question. And in this case, the new turbine will produce future economic benefit and the cost is measurable. Hence, the items would be recognized as an asset. The original invoice for the machine did not specify the cost of the turbine. However, the cost of the replacement 45 lakh can be used as an indicator of the likely cost 6 years previously. If discount rate is given 5%, so 45 lakh discounted back 6 years, it will be give you 33,57,900, right? That is the approximate cost of turbine before 6 years. Okay. The current carrying cost of the turbine which is required to be replaced. So how have you arrived at this current carrying cost? So let me take you on the Excel file and there I'll show you that how this accounting treatment has to happen. Illustration number 8, right? And I'll do just here. This is illustration number 8, right? I'll just show you the calculation, okay? Because accounting entry, everything you are aware. Let me put all these things here. Right. Particulars, then your estimated cost of turbine and remainder of the machine, right? So before that, I need to arrive at the estimated cost of the turbine because the total value is given, which is 1 crore. replacement cost of new turbine. How much it is? The replacement cost of new turbine is 45 lakh rupees. 1, 2, 3, 4, 5. 45 lakh rupees. Discount rate is 5%. Year, or let's say life completed 6 years, right? So present value in the beginning, considering this replacement cost in the beginning, 45 lakh divided by 1 plus 5% to the base to the power 6 to the power 6. It gives you 3357 and 969. You can round off. You can round off also. You can round off nearest 1 or nearest 10. You can round off also that. Let's say 3357 970, right? I just rounded off 3357 970. This is my estimated cost of the turbine, right? The beginning. Now, what is the remainder of the machine? The remainder of the machine is the total value of the machine is 1 crore. So 1, 1, 2, 3, 4, 5, 6, 7 minus this 66 lakh 42,030 is my this thing, right? Life is 10 years because life was 10 years initially, but this turbine becomes faulty and that is why it requires replacement. Coming to the accumulated depreciation, this is my carrying value at the time of replacement. In the question, it is given, but time is not given. So write down carrying value as at the carrying value at the end of 6 years. Accumulated depreciation is this divided by this multiply by 6. Likewise, this will be for this thing also. You can say 60 lakh rupees. For 6 years, it is 60 lakh rupees. What is my carrying value at the end of 6 years? This is the carrying value at the end of 6 years. Right? So what you need to do? What accounting entry you need to pass? The accounting entry you need to pass your replacement. This accounting entry you need to pass. At the time of replacement, you need to pass this accounting entry, right? Capitalize the new turbine machine turbine account. Okay. And what is the value of the machine turbine account debit bank account? 45 lakh. The value of the new machinery. They recognize the old turbine. What is your accumulated depreciation? This much. What is your old turbine gross block? Your old turbine gross block is how much? Your old turbine gross block is your 357 970. What is your loss on replacement? This minus accumulated depreciation. This carrying value is the loss on replacement, right? This is how it is going to be done. This is how it is going to be done. Now, revised numbers, revised figures of machine. What will be the revised figures of the machine? The machine will have new turbine and the remainder of the machine. So what value will be reflected in your fixed asset register? In your fixed asset register, the gross block, accumulated depreciation, and the net block will be reflected like this. Right? The value of the new turbine, since it has not yet depreciated, the value of the new turbine will be reflected here. Remainder of the machine gross block was what? Initially it was 66 lakh 42,000, right? यही होगा ना, जो रिमाइंडर ऑफ द मशीन का ग्रॉस ब्लॉक को मैंने पूरा ले लिया 66 नए वाले टर्बाइन का मैंने वैल्यू ले ली. यू कैन सी वैल्यू बिकम 1,11,42,030. Your accumulated depreciation is nothing because it is yet to be depreciated. And your remainder of the machine का depreciation कितना है 6 years तक? It is 39, 85, 218. What is your carrying value? Your carrying value is this one. Your total net block is 71,56,812. This is how revised value will be reflected. Friends, please let me know if you have any doubts so far. I have solved two studies, one from ICAI study material, that is turbine and machine. The first one is from my side, which is truck and engine. I hope you guys are well clear about this. Why this kind of a concept is there? This kind of concept is there because the subsequent cost, if it is a major replacement, major repairs, it is a major inspection, right? In that case, you have to capitalize the new cost. When you capitalize the new cost, you have to decapitalize the old cost. Ravish was asking, sir, what happened if let's say instead of replacing this engine, we are buying a new engine like aviation. In aviation companies like SpiceJet, Indigo, Air India, what they do, they used to keep a spare engine. Right? So they used to keep a spare engine as a spare part. So whether that engine is going to be capitalized, answer is yes. Because we understand that spare parts, servicing equipment, and standby equipment will be capitalized as a PP if it met the definition of PP. But if a particular part is already damaged, it is faulty, in that case, it has to be derecognized and new part is going to be capitalized, right? I hope you guys have understood it very well. Let me know if you have any doubt. Friends, if you understood it very well, yes or no? Very good. Clear in mind or clear from mind? Clear in mind or clear from mind? Very good. Clear in mind. Subsequent cost, major inspection or overhaul. Regular major inspection for faults may be a condition of continuing to operate an item. The cost of each major inspection is recognized in the carrying amount as a replacement if the recognition criteria are satisfied. Any remaining carrying amount relating to the previous inspection is derecognized, irrespective of whether previous inspection was separately identified and depreciated. Sir, what does it mean? Friends, just to give you a practical example out of it, please write down a homework. Please download the annual report of Interglobe Aviation Limited, Indigo Airlines. Go to the accounting policy part for property, plant and equipment. You know what you will find. So in the major component of the aircraft, they have also one of the component as a major inspection. What is that? Let me tell you. Friends, aircraft is kind of an item which deals with the life of the people. Means So aircraft is flying in the air with so many lives, 100, 200, 300, 400, right? If there is any problem in the air, so no one will be able to survive, whomsoever was sitting in the plane. Now what happens? As per the DGCA, as per the rules of the aviation authority, these aircrafts should undergo a major inspection. Doesn't matter. It is flying absolutely right. It is flying absolutely well. Still, after passing some flying hours, after completing some flying hours, or after completing some period of years, some period of life, they have to undergo with a mandatory inspections, right? And these mandatory inspections are very costly. For example, if the cost of the aircraft is 100 crores, and at the end of every 4 year, they have to go to a mandatory inspection. So the mandatory inspection cost rupees 10 crore, 5 crore. So these kind of cost may be there. Now the question arises, sir, when a company buy an aircraft, of course it is well inspected. भाई जब आप नई गाड़ी खरीदते हो, नया एयरक्राफ्ट खरीदते हो, तो तब तो इंस्पेक्टेड ही होगा ना. तभी तो आपको फिट फॉर फ्लाइंग का सर्टिफिकेट मिलेगा. So the new aircraft is already an inspected aircraft, and the life of the aircraft is 20 years. Now, after 4 years, you are required to get the major inspection done. After 4 years, you are required to get the major inspection done. Now, what happens? Out of this 100 crores, the cost of the aircraft is 100 crores. Don't you think the inspection also has a cost? As I told you, after 4 years, you have to spend around 10 crores. So it means the new aircraft which has already been inspected, it also has some cost of inspection. Let's say the estimated cost of inspection is 8 crore. 8 crore. So friends, don't you think if the life of aircraft is 20 years, this inspection will happen at the 5 times in the life of 20 years? So don't you think this 92 crore has to be depreciated over a life of 20 years, but this 8 crore has to be depreciated over a life of 8 years, sorry 4 years. या भाई अगर आपके पास 100 करोड़ का एक एसेट है, आपको पता है कि 8 करोड़ की जो वैल्यू है ये मेरे पास फिर से आएगी 4 साल के बाद. सो इस 8 करोड़ की लाइफ तो सिर्फ 4 साल है, बाकी 92 करोड़ की लाइफ 20 ईयर्स है, राइट? सो फ्रेंड, स्टैंडर्ड सेज दैट if a regular major inspection for faults may be a condition of continuing to operate an item. Sir, what happens if this aircraft will not undergo with the mandatory inspection? Then DGCA will not approve these aircraft for flying, right? For example, there was a new aircraft which has completed 4 years, but the airline has not get the inspection done for those aircraft. Why? Because the airline does not have money, let's say, or they are running from cash crunch. So that is why they have deferred or postponed the inspection. Friends, the standard says that in that case, the standard says in that case, probably the aviation authority will not allow this aircraft to fly. Why? Because it is dealing with the lives of the people. So in this case, standard says that first of all, this major inspection component has to be capitalized separately since beginning. It has to be depreciated over the life of the inspection. The remainder of the aircraft has to be depreciated over the life of the aircraft, which is 20 years. So this is what it is there in terms of major inspection. Let's understand this case study. Udan Limited buys an aircraft for rupees 90 lakhs. Under civil aviation rules, the aircraft requires a major inspection every 3 years at a cost of rupees 5 lakh. 3 years after purchase, it undergoes its first major inspection. The cost in relation to this inspection amounting to rupees 7 lakhs. Explain how the same should be accounted for in accordance with the requirement of Ind AS 16. So the inspection cost was 5 lakh. After 3 years, when the first inspection done, it was costing rupees 7 lakh. That was the actual cost. So when it was started, the total cost was 90 lakh. When it was started, so normally the major inspection was 5 lakh. So the opening inspection cost was also given. So how to do this thing? the original carrying value would have been allocated as follows: aircraft plus cost of inspection. 85 lakh belongs to the aircraft, 5 lakh belongs to the inspection. The total is 90 lakh. Let's say life of the aircraft is 20 years. Okay. Friends, just give me a minute. Yeah, sorry. In this case, assuming the life of the aircraft is 20 years, this 85 lakh has to be depreciated over a period of 20 years. This 5 lakh has to be depreciated over a period of 3 years because the life of inspection is 3 years only. So every major component has to be depreciated to its useful life. So Ind AS 16 provides that in such case, original cost of inspection is derecognized and the new inspection cost will be recognized in the carrying amount. So new inspection cost will be accounted for as an asset addition and the original cost as an asset disposal. Aircraft 85 lakhs हो गया. Inspection component is equal to original cost of inspection minus derecognition of original inspection plus new inspection. So if I talk about the aircraft gross block, it will be 85 lakh gross block. But what is inspection gross block? Initially, it was 5 lakh, which is going to be derecognized. It becomes 0. And the new 7 lakh will be capitalized, which becomes 7 lakh. The total gross block will become 92 lakhs. The revised gross block is 92 lakh. Gross block, not net block, revised gross. Right? I hope it is well clear to everyone. Okay, I'm so sorry. I think the Excel was visible that time. So friends, this was the case study which I have discussed right now. Udan Limited buys an aircraft for 90 lakhs. Under civil aviation rule, the aircraft requires a major inspection every 3 years at a cost of 5 lakh. 3 years after purchase, it undergoes its first major inspection. The cost in relation to inspection amounting to 7 lakhs. This is how it is going to happen. Guys, are you comfortable with this? Are you comfortable with this? You can see how this has to be done. This is 85 lakh is the aircraft value, 5 lakh is the inspection which is inbuilt. This 5 lakh has to be depreciated over a period of 3 years. This 85 lakh has to be depreciated over a period of 20 years, assuming the life of the aircraft is 20 years, right? And this is the revised gross block, 85 lakh for aircraft, and the new inspection cost of 7 lakh. Total revised block is 92 lakh. This is how it is happening, right? I hope it is clear to all of you. Nisha, Pooja, Vijay, Rahul, Viraj, Vivek, is it clear? Shall I move forward? Shall I move forward? Measurement and initial recognition. Friends, we understood the recognition part. We understood future economic benefits should be probable and cost can be measured reliably. And this is good. This is good for everything. This is good for initial recognition as well as subsequent recognition. So we understood initial cost. To remember, I have taken an example of when the machine was brought in from China and immediately government banned the output which is from the machinery, right? So then we discussed the subsequent replacement, subsequent part replacement, subsequent major inspection, how it is happening. So of course, the new inspection cost, the new replacement value has to be capitalized as a part of the cost of the asset, right? Has to be capitalized as a part of the cost of the asset. Okay. So this is how it is happening. This is how it is happening. Yeah. Now let's talk about measurement. And when I talk about measurement, the PPE has to be initially measured at cost. PPE has to be initially measured at cost. And there are three legs of the cost. Number one, purchase price. Purchase price. For example, when you go to buy a car, you have to pay a cost of the car, you have to pay a value, purchase price, you got an invoice, including import duties and non-refundable purchase taxes. Including import duties and non-refundable purchase taxes, right? So purchase price including import duties and non-refundable purchase taxes. For example, and this is a real life example, when you buy a car, you will not get the refund of GST. You will not get the input credit on GST. So this GST is a non-refundable purchase taxes. So this GST is going to be capitalized with the value of the car. Purchase price plus import duties plus non-refundable purchase taxes minus trade discount and rebates. If there is any trade discount and rebate, it has to be deducted, right? So this is the cost of the asset, the first leg. Number two, directly attributable cost. What is meant by directly attributable cost? Directly attributable cost means those costs which would not have been incurred, had the asset not been purchased. अगर एसेट नहीं होता तो वो कॉस्ट भी नहीं होती. फॉर एग्जाम्पल, द कंपनी हैज परचेज्ड अ मशीनरी फ्रॉम चाइना. So while the purchase price of the machinery, while the GST import duty on the machinery is going to be capitalized if it is a non-refundable taxes, while the discount has to be deducted, but there are few costs, there are some cost which is related in the acquisition of this machinery. For example, when this entity is buying a machinery from China, there is a cost. The machine will come from the Chinese plant to the Shanghai port. It will have a transportation cost. The machine will come from Shanghai port to the Kandla port, right? There will be a transportation cost. From Kandla port, it will reach to the factory of the company in New Delhi. Again, there is a transportation cost. There is a freight, right? There is an installation cost of the machinery. Until and unless it is installed, it cannot be work for the future economic benefit, right? So there is some inspection, there is some mandatory inspection cost as well, right? Friends, would you think अगर ये मशीनरी परचेज नहीं हुई होती तो क्या ये ट्रांसपोर्टेशन, फ्रैट, carriage inward, installation, whether these things will happen? Answer is no. These things will not happen. Answer is right. So directly attributable cost. Friends, this directly attributable cost is also going to be capitalized. The transportation cost, freight from Chinese plant to Shanghai port to Kandla port to factory, installation cost, this is also going to be capitalized. I hope you guys are able to understand this part. Yeah. Yes, site preparation cost. Like you are just doing some civil work. For example, when this tower company, you must have seen the telecom tower. When this tower company are installing the tower, they are doing a lot of civil work as well. They are creating a platform, they are constructing a platform on which the tower is built, right? So this will be capitalized. Directly attributable cost. Number three, initial estimate of the cost of dismantling and removing the item and restoring. What it is, friends. The point number one and point number two is quite easy. What is the point number three? What is point number three? Let me talk about point number three. Friends, let's say a company has taken a building on a lease basis. A company has taken a land on a lease basis. Land, not building, land. Now lease term of the building, the lease term of the land is 30 years. The building has been taken on lease and the life is 30 years. The land is taken on the lease and life is 30 years. Now the company has constructed the building on that land. The company has constructed the building on that land. Now what happens? As per the agreement with the lessor says that I have given you a plain plot of land. I have given you a plain plot of land. So after 30 years, I need my land back into the same condition in which I have given it back, in which I have given it to you. So I need my land in the same condition in which I have given it to you. Right? So friends, in this case, after 30 years, when the company has to return this land to the lessor, the company has to dismantle, the company has to decommission, the company has to dismantle, the company has to decommission, the company has to destroy this entire building and restore the land in the same condition, restore the land into the same condition in which it has taken from the lessor. Friends, this decommissioning and the site restoration obligation has some cost, right? You will not dismantle or you will not restore the site free of cost. You have to pay some huge cost around that. So, friends, standard says that whenever you are constructing an asset, if there is an obligation to restore or decommission or dismantle this asset at the end of the life, you need to estimate the you need to initially estimate the cost of dismantling and removing the item and restoring the site, right? And that amount you need to capitalize upfront. You need to capitalize upfront. For example, you estimate that after 30 years, I need to pay up. I need to pay an obligation of 30 lakh rupees for this decommissioning obligation. So you need to capitalize this 30 lakh rupees on the basis of present value today, right? And this amount should be depreciated over the life of the asset. And you will be having one of the kitty, you will be having a provision at the end of 30 year amounting to rupees 30 lakhs, right? Friends, how is it happening? So let me show you on an Excel file, right? And please confirm if the Excel file is visible, right? Please confirm if the Excel file is visible. Let me talk about the initial estimate of the decommissioning or site restoration cost. Let me talk about that. Right. So measurement and initial recognition. understood three parts: measurement and initial recognition. We understood. And here we understood that the measurement and initial recognition should be at cost. Should be at cost. Okay. Friends, the three parts are purchase price plus import duties plus non-refundable taxes, right? The second one is directly attributable cost. The third one is estimated cost of dismantling and restoration. Now let me tell you the estimated cost of dismantling and restoration. Let me give an example of asset retirement obligation, right? So that you will be able to understand this part. Example of asset retirement obligation. Company has constructed a factory over a leasehold land to be dismantled after 20 years. The cost of factory is rupees 10 lakhs. The company estimate the dismantling liability to be rupees 5 lakh after 20 years. The current incremental borrowing rate for the entity is 10 years. The discount rate is 10%. You are required to show the necessary impact for Ind AS 16. Whether the question is clear? Whether the question is clear? Is it clear? Is it clear or not clear? What is my cost of asset here? My cost of asset is cost of construction plus estimated cost of dismantling. My cost of construction plus estimated cost of dismantling. It is my cost of the asset. Now let me tell you the estimated cost of dismantling, how it is going to be calculated. Friends, the cost after 20 years is 5 lakh. Discount rate is 10%. Period is 20 years. Right? Now I need to compute the present value factor and present value. Cost after 20 years is 5 lakh. Discount rate is 10%. Period is 20. How to calculate present value factor? Present value factor is equal to 1 divided by 1 plus 10% to the power 20, which is the life. This will give me the present value factor. This will give me the present value factor of 149. This will give me the present value factor of 149. And how to calculate the present value? When I'll multiply the future value with the present value factor, it will give me the present value, which is 74,321. 74,322, right? So friends, in this case, my cost of asset is equal to cost of construction plus estimated cost of dismantling plus estimated cost of dismantling. So this will be 5 lakh plus 74,322. This will be equal to 5 lakh plus 74,322. This is 5,74,322. This will be your cost of asset, which is depreciated over a life of 20 years. So how this will be depreciated? What is the depreciation? Let me prepare a depreciation chart here. Depreciation chart. In the depreciation chart, there will be the year, then your gross block, right? Or I would say that opening value, right? Your depreciation, your closing value. Year. This is year, and let me write this year till 20. Okay. Your opening value. What is your opening value? 574322. What is your life? What is the life? Life of the asset is 20 years. The life is 20 years, right? What is your depreciation? This divide by 20. This will be your depreciation. This will be your depreciation. What is your closing value? This will be your closing value. In the second year, this closing will become opening. The depreciation will be same, straight line method. This is your closing value. And when I draw this to the 20 years, you will find the closing value will become zero. It has become zero, right? Why? Because the total depreciation is 5742, which was depreciated over the useful life of 20 years. Now, friends, sir, I understood that this cost of asset, right? When you put this entry, I understood that 5,74,322 is the cost of the asset. And what you have done, building PPE account debit, right? Building PPE account debit, building PPE account debit 574322 to bank account. And what is my bank account? 574322. Answer is no. The bank has already been debited by 5 lakh, which is construction cost. This next one is 2. Provision. Decommissioning cost you will pay after 20 years. Provision for decommissioning or site restoration. Provision for site restoration. This is also known as decommissioning. Right? 74,322. How much of you are okay with this entry? Let me know if anyone has any problem with this entry. Yeah. Sorry, I have just done something wrong. The cost of the factory was 10 lakh, not 5 lakh. The cost of the factory was 10 lakh in this question. So it should be 10 lakh here. It should be 10 lakh. Okay. And it should be 10 lakh 74,000, right? 10 lakh 74,322. Bank is 10 lakh, right? And this cost was 5 lakh after 20 years. So it will come like, right? This is what it is, right? This is what it is. Guys, have you understood this thing? How I have done this capitalization of building? So the site restoration cost on the basis of present value, I have added to the cost of the asset. You're right, Pooja. It is not 10 lakh, it is 10 lakh. You're right. That was my bad. Okay. Sir, what happens with this provision for site restoration? What happens with that? So let me give you what happens with the site restoration cost. Again, I'll prepare this provision chart. Like I prepare the depreciation chart, I'll prepare the provision chart. And I'll give you year, opening balance, interest cost, and closing balance. Here again 1 to 20. Because this provision has to be paid after 20 years. What is my opening balance? My opening balance is 74,322. This is the present value of the opening balance. Interest cost, you have discounted it at the rate of 10%. Again, you have to unwind the discount, right? You will read this in detail in Ind AS 37 provision standard. ये आप डिटेल में पढ़ोगे, बट मैं यहां भी बता देता हूं आपको. This will be the interest cost, closing balance. Every year one interest cost will be there, right? And in the second year, this will become the opening balance. This is your interest cost. This will be your closing balance. So that this will run till 20th year. And you can see that it become how much? At the end of 20th year, it becomes 5 lakh rupees. This is what you have estimated. This is what you have estimated. right? The beginning of the at the beginning, when you constructed this building, you have estimated this 5 lakh. This is how this provision chart and depreciation chart will work. This is how it will work. Friends, I hope regarding this measurement of PPE, this measurement of PPE is at cost, which includes 3 lakhs, which is purchase price plus import duties plus non-refundable taxes minus trade discounted rebates plus directly attributable cost plus estimated cost of dismantling and site restoration, right? So this is what I have shown you on the Excel file. Friends, do let me know if you have any questions so far. Do let me know. If you don't have any question, then I'll move on to my presentation. So these are the 3 legs of cost. This is a very important aspect. So friends, what is meant by directly attributable cost? I told you directly attributable cost means cost directly related to bringing the asset. Remember, वो एग्जाम्पल मशीन को फैक्ट्री में लाने तक का खर्चा और मशीन से आउटपुट प्रोड्यूस करने तक का खर्चा इज टू बी डायरेक्टली एट्रीब्यूटेबल कॉस्ट. So cost directly related to bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by the management. Employee benefit cost arising directly from construction or acquisition of PPE. Cost of site preparation, right? For example, the company has engaged its employees in the construction of the factory. So those salary of the employees will be capitalized. Cost of site preparation. The company is doing some excavation. The company is putting some civil work. The company is creating a platform for the installation of the machineries. So these will be capitalized. Initial delivery and handling cost, right? When the machine was brought in, there is a transportation cost, delivery cost, installation cost. It is a directly attributable cost. Professional fees. The company has paid a consulting fee for the to the consultant for giving the training to the employees so that they will able to run the machinery. Cost of testing, whether the machinery is working properly or not, right? You must have seen the trial run production. For example, in case of metro, they are doing the trial run. Okay, so whatever the trial run cost is there, it is also going to be capitalized. But let's say if the metro is doing a trial run and they are selling the tickets at 50%, or the theater is doing the trial run and they are selling 25% tickets at 25% cost. So trial run cost is capitalized, but whatever money which is coming in from the trial run, that has to be deducted from the cost of the asset. Anisha has one question. Sir, when we recognize the amount of dismantling in the cost of PPE, then we calculate the depreciation on such cost also. Then why charging separately interest cost also in the P&L? Isn't not the double recognition of the cost on one item itself? Tanisha, when you purchase a PPE, what accounting entry you pass? PPE account debit to bank account. What are the two line item which is getting impacted? One, PPE. Number two, your bank balance. Something is coming and something is going out. Number two, why this dismantling cost will happen? This dismantling cost will happen because you have constructed on the leasehold land. So this dismantling is directly related to the construction of the factory. Had the construction not been there, the dismantling will not be there. So that is clear. Now, after 20 year, I have to pay, I have to credit my bank. After 20 year, I have to credit my bank by 5 lakh rupees. Today, I am not crediting my bank. So today I am debiting my PP, right, Tanisha? Today I am debiting my PP. I am debiting PP by 5 lakh rupees. And today there is no outflow. But I need to create a provision today. Since there is no any outflow, today I have to credit some liability. So that is a provision. And this provision, the asset is sitting at 75,000 rupees. The provision we have created at 75,000 rupees. Had we paid the amount upfront, the entry would be provision to bank, sorry, asset to bank. But since we have not paid, we made an entry asset to liability. Tanisha, are you agree with this entry asset to liability? I hope you are agree with the entry asset to liability. So now let's talk about asset first. Let's talk about asset. If I pass an entry asset to bank, I am depreciating the asset over the useful life. Likewise, I am depreciating this 75,000 over the useful life, right? But what will be my expense after what will be my expense after 20 years? Is it 75,000 or is it 5 lakh? Is it 75,000 or is it 5 lakh? 5 lakh. Expense is 5 lakh, na? So 75,000, your day one entry is 75,000 asset debit to 75,000 liability. On 75,000, you are charging a depreciation. On 75,000, you are charging a depreciation. Let me show you in the P&L. On 75,000, you are charging a depreciation. 25,000 is 74,322. You are charging a depreciation over the life of 20 years. Means P&L में 74,322 depreciation की form में जाएगा. And this 74,322, if you will deposit in the bank today, it will give 5 lakh rupees after 20 years. It means you have considered a liability of 74,322. You have to make it 5 lakh in 20 years. How will you make it this liability 5 lakh after 20 years? You will credit your liability. And what will be the accounting entry? Interest expense account debit to liability account. Now coming to your question, sir, are we not doing a double recognition in the cost? So we all understand my total cost is 5 lakh rupees. My total cost, total, let's write here. My total cost is how much? 5 lakh rupees. Depreciation in the P&L, it was in 20 years. How much? 74,322, because this depreciation you will charge. 74,322, this depreciation you will charge. Right. Now interest cost in the P&L in 20 years. How much? How much? So 74,000 entry you have done. Asset to liability. And now this 74 has to be 5 lakh. How much is the interest cost? How much is the interest cost? Let me give you the total of interest here. In 20 years, the total interest cost will be how much? See, in 20 years, you have only charged 5 lakh rupees. The total cost is 5 lakh rupees. And in the P&L, you have charged 5 lakh rupees only. That is what you have charged in the P&L. Nisha, is that okay? $74,000 you have charged in the P&L as a depreciation. 4,25,000 you have charged as an interest cost. Is it okay? Very simple. Now, friends, so I have given you the example of directly attributable cost, but few items will not be qualified as a directly attributable cost. Cost of conducting business in a new location or with a new class of customer. For example, the company has moved its factory from India to China. And now they are giving a training to Indian employees for the Chinese language, right? So this kind of a training cost is not going to be capitalized. It has to be charged to the P&L. Cost incurred in introduction new product or service, right? Or cost of opening a new facility. For example, the company has invited Mr. Amitabh Bachchan to promote a new product, or the company has invited Mr. Amitabh Bachchan to inaugurate their factory, and Mr. Amitabh Bachchan charged 5 crore rupees for the promotion or inauguration of that factory, right? So this will be charged to P&L. This will not be capitalized. Administrative and other general overhead costs. For example, audit. The company is, the company is also creating a factory, constructing a factory. So the company is getting the audit done for this entire company as a whole. So this audit fee is not part of your directly attributable cost. This compliance matter, audit fee, return filing fees, these are the administrative and other general overhead. Finance department expenses, corporate office expenses, these are the administrative and other general overhead costs, and this is not going to be capitalized. Commissioning cost we have discussed. Now let's discuss this case study, and it is much similar to the ICAI study material. Measurement at initial recognition, case study 4, right? Okay, friend, let's go. I can see a lot of responses today. I can see the participants are very interactive and participative today. So in the last 2.5 hours, there are more than 350 responses on the query box or query link of ICAI. Yes, coming to this measurement part, measurement at initial recognition. ABC Limited purchased a furnace machinery for a gross price of rupees 200 crores. ABC Limited is purchasing a machinery, furnace machinery, like a steel plant. In a steel plant, there is a blast furnace. The gross price is 200 crores. The seller granted 0.5% rebate on the gross price. What is 0.5% of 200 crores? The purchase price is 200 crores. There is a trade rebate. There is a trade discount and rebate of 0.5%. 200 multiplied by 0.5% comes out at 1 crore, right? Right? So 200 crore, 0.5%, 1 crore. The gross price includes excise duty of rupees 20 crore, for which input credit can be claimed by the company. So is it a non-refundable tax? Is it a non-refundable tax? It is not a non-refundable tax. It is not a non-refundable tax. It is a refundable tax. The credit can be taken for this excise duty. So whether it will form part of the cost of the asset, answer is of course no. Right? So 200 crore is the gross price, 1 crore is the rebate, 20 crore is your how much? 20 crore is your excise duty, refundable taxes, right? Refundable taxes. In this case, if you can see, 200 crore is purchase price, 1 crore and 20 crore. This has to be reduced to compute the purchase price net of non-refundable taxes and trade discount and rebates, right? Net of refundable taxes. Right? So 179 is the purchase price. 179 is the purchase price. It says that what happened if the excise duty credit cannot be taken, then it will become part of your fixed asset. It will become part of your PP. It also incurred rupees 15 crore as a transportation cost, handling charges and insurance, right? 5 crore for installation and 3 crore for testing and professional fees. Whether this will be capitalized, answer is yes. It is a directly attributable cost. So 15 crore of transportation cost, 5 crore for installation cost, and 3 crore for testing and professional fees is going to be capitalized. It has earned rupees 0.2 crores from selling goods produced out of testing. So during the trial run, if there is any revenue, this has to be reduced from your cost of asset, right? So this has to be reduced from the cost of the asset. So you can see this 15 crore, 5 crore and 3 crore minus 0.2, 2.8 crore. This is also added to the cost of the asset as a directly attributable cost. The company borrowed 100 crore for financing the new purchase at the rate of 10%. See, the company has taken a borrowing for this factory. Entire process of purchase to make the operation took 15 months. And the time period is 15 months. Is it a qualifying asset? Answer is yes. It is a qualifying asset because this construction of a furnace will take a huge amount of time, significant, substantial amount of time. It is your qualifying asset. The loan was outstanding during the period. Friends, so what should I do? 100 crore, interest 10%, 15 months. What is your total amount of borrowing cost? 100 crore multiplied by 10% for 1 year, 10 crore. What is for 15 months? So 10 crore means for quarter it is 2.5 crore. So 12.5 crore is the amount for the entire 12.5 crore is the amount for this entire 12.5 crore is the amount for the borrowing cost, right? This is the borrowing cost. 12.5 crore. Then it is writing that the company earned a temporary income 0.1 crore from short-term parking of the money borrowed pending payment to supplier and meeting all costs. You remember in Index 23, I talked about two concepts, specific borrowing and general borrowing. If there is a specific borrowing, then the actual borrowing cost minus temporary income from the idle funds, right? Temporary income has to be deducted in the borrowing cost. So 12.5 crore is the borrowing cost, but 0.1 crore, which the company is receiving, this has to be reduced from the borrowing cost, right? What should be the initial cost of the machinery? Friends, in this case, we have already talked about the purchase price, directly attributable cost, and this is the borrowing cost, right? And this will be the total 216.20 is your total cost of asset at the time of initial recognition. Please let me know if you have any doubt, if any question so far. Please let me know, friends, if you have any question. Are you good so far? Are you able to understand? Are you good so far? Yeah. Are you good so far? Very good. Fantastic. Fantastic. Right. Friends, we discussed the measurement at the time of initial recognition. Now there is one more part in this measurement at the time of initial recognition, deferred payment credit. Standard says that the cost of an item of PP is the cash equivalent at the recognition date. In case payment is deferred beyond normal credit terms, the difference between the cash price equivalent and total payment is recognized as an interest over the period of credit unless such interest is capitalized. Sir, what does it mean? For example, I went to buy a car, right? And I asked the car dealer, what is the price of this car? Maruti Swift. The car dealer told me that the price of this car is 10 lakh rupees. I paid a cash upfront and I bought a car. What is the entry, accounting entry? Car account debit to cash account or to bank account, right? Second example, Tanisha went to the car dealer and Tanisha said, I need a car, Maruti Swift car, but I'm a student. I'm a student. I don't have 10 lakh rupees upfront. So the dealer asked Tanisha that in how much period you can pay this entire amount of this entire amount. Tanisha said that I will be able to pay in 2 years, right? So the dealer said that in this case, the price of the car is 12 lakh rupees. Friends, why the dealer is charging extra money from Tanisha? So he has sold this car to me at 10 lakh rupees, but she is asking 12 lakh, but he is asking 12 lakh rupees from Tanisha. Why he is asking 2 lakh rupees extra? For the time value of money, I am paying him upfront. My cash price equivalent is 10 lakh rupees. So basically my cash price is 10 lakh rupees. I need to pass an accounting entry car account debit to cash 10 lakh rupees. Tanisha is paying 12 lakh rupees. So whether she will pass car account debit to cash account 12 lakh rupees, answer is no. Standard says that if you are buying an asset at the deferred payment term, in that case, the asset is always capitalized at the cash price equivalent. So in this case, the cash price equivalent is 10 lakh rupees. So Tanisha will pass an accounting entry, car account debit 10 lakh rupees, to bank account 12 lakh rupees. The 2 lakh rupee will go to the interest cost, interest account debit. Sir, whether this interest will go to the P&L or this interest will be capitalized. The interest will only be capitalized if it is a qualifying asset as per Ind AS 23. In my example for a car, this asset is a complete asset when the company has bought the asset. In this case, it will not going to be capitalized, right? So friends, the moral of the story is the PPE needs to be capitalized on the basis of cash price equivalent at the recognition date, right? If the payment is deferred beyond normal credit terms, and if the seller is charging extra, that extra will go to the interest cost. That extra will be capitalized if it is a qualifying asset as per Ind AS 20. I hope everything is clear in your mind. I hope you guys are good so far. Everything is clear in your mind. Very good. Let's move on. Friends, let's do one illustration on the deferred payment credit from ICAI study material. On 1st April 2001, an item of property is offered for sale at 10 million. 10 million is 1 crore. With payment terms being 3 equal installments of 33 lakhs 33,333 over a 2-year period. Payments are made on 1st April 2001. See, the recognition date is 1st April 2001, and the entity is paying the first amount, the first installment on 1st April 2001, the second installment after 1 year, and the third installment after 2 years. The rate of interest is 5.36%. You are required to show how the property will be recorded in accordance with Ind AS 16 and pass the necessary journal entry. Friends, what is the cash price equivalent first of all? The cash price equivalent is how much? Is it 1 crore? Is it something else? So the item of the property is offered for sale at rupees 1 crore. And 3 equal annual installment 33, 33, 333. Right? Now we need to compute the cash price equivalent. In this case, first of all, if you will see here, you are doing 3 payments 33, 33, 333, 33, 33, 333, and 33, 333. Now the discount factor at the rate of 5.36%. For the first payment, it is 1 because on the recognition that the payment is happening. The second one is 0.949. The third payment is 0.901. This will give you 95 lakh rupees. This is your cash price equivalent. This is your cash price equivalent because the entire 1 crore includes interest portion also, right? What is the accounting entry on day one? What is the accounting entry on day one? What is the accounting entry on day one? Can you tell me what is the accounting entry on day one? PP account debit, property, plant and equipment account debit 95 lakh. 2, bank account because the payment is upfront, the first installment 33, 33, 333, and the remaining is your accounts payable. 61, 66, 667. Now what happens later on? Later on, let me show you the interest schedule also. On day 1, 95 lakh was the opening balance. Total payment is 33. Principal amount, of course, no interest is there because it is day 1. So closing balance 61, 66, 667. This will become the opening balance. The interest has to be charged on this balance 330, 533. The total payment is this one. So principal portion is 33 minus 330, 30 lakh 2,800. Closing balance is this one. This will become the opening balance. You have to charge an interest, right? And this will become 0. Okay, this will become 0. So friend, this is how you have to pass an entry. On 31st March 2001, 2002, interest expense account debit, accounts payable account debit to bank account. In a similar fashion, on 31st March 2003, interest expense account debit, accounts payable debit to bank account 33, 33, 336. This is how this accounting has to happen. Are you clear on the accounting? Please let me know if you're clear on this accounting. Or do you want me to cover it again? Please tell me. Would you like to cover it again? Or you are good? Are you good? Simple. What we have done, the total payment is given, the installment of 33, 33, 33, right Rahul? तो अगर मैं 33, 33, 333 को मल्टीप्लाई बाय 3 करूंगा तो क्या आएगा? 1 करोड़. Is it a cash price equivalent? Of course, answer is no. आपको 1 CR you need to pay in 2 year time. So of course it is not a cash price equivalent. Cash price equivalent means upfront payment you are paying, or as per the normal credit terms. So that is why I have computed the present value. The present value of the first installment is same because it is paying upfront. For the second installment, 1 year discounting. For the third installment, 2 year discounting. So this is coming out at 95 lakh and asset has to be recognized at 95 lakh rupees. So first entry, asset account debit to payable account 95 lakh. Then payable account debit by 33 because upfront payment. 61 lakh you need to charge an interest. You need to charge interest and you need to pay EMI. So this is how your balance will be nullified, crystallized in 2 year period, right? So friends, it's 9:45 now and I want to call out the session, right? Friends, since beginning, we have understood apart from objective and scope, we have discussed the uh, the meaning of property, plant and equipment, which is tangible item held for use in production or supply of goods and services, and which is expected to be used for more than one period, which is largely 12 months. Then we discussed PPE has to be recognized when two conditions will be satisfied. I'm just making a revision in the next minutes so that if you have any question, you can ask that question as well. Future economic benefits should be satisfied and cost can be measured reliably. If these two conditions will be satisfied, you need to recognize a PPE. This condition is same for initial cost as well as subsequent cost. If I talk about subsequent cost, the major replacement cost and major inspection cost has to be capitalized, provided the old component needs to be decapitalized, right? If you are aware about the cost on the day one, and if these replacement or inspection has a different useful life, you need to split the cost on day one and you need to depreciate it over the different useful life. Like I have shown you for this aircraft, okay, inspection and aircraft. I have told you regarding that turbine and machinery, engine and truck, right? Then we discussed the measurement at cost, the initial measurement. Initial measurement should be at cost. Cost includes purchase price plus import duty plus non-refundable taxes minus trade discount and rebates plus directly attributable cost plus estimated cost of dismantling, right? Then we discussed deferred payment credit. In case if the payment is postponed, the asset is acquired on a deferred payment credit basis. In that case, the asset needs to be capitalized at cash price equivalent. The difference between the actual payment made versus cash price equivalent, like in the last example, 1 crore and 95 lakh, 5 lakh rupees has to be charged as an interest cost in the P&L. Whether it should be capitalized if it is for the qualifying asset, right? If the asset is a qualifying asset, it can be capitalized as per Ind AS 23. This is what we have discussed. We took so many lemon examples. We did few case studies, practical numericals, right? With accounting entries and the practical problems, right? Vansika, the PPTs will be uploaded today. Don't worry about that. Do you have any question or everything is clear in mind? Guys, everything is clear in mind? Nothing is clear out of mind? Clear in mind or clear out of mind? Clear in mind. Thank you so much, students. Thank you so much. I would request each one of you that please solve all the problems from ICAI study material today itself, right? Thank you so much. Bye-bye. Take care.